Is the Fed trying to bail out money markets? I'll show you why one banking expert thinks so. Plus, we just hit an unemployment cliff and what that means for the economy going forward. All that and more in today's Macro Show. I'm your host, Steven Van Metre, and thanks for joining me today. Let's get right into what is a continuation of last week's topic of this reverse repo mess. In fact, we just hit a new record in reverse repo operations. Let me show you. The Fed took in today $765.141 billion worth of cash in exchange for Treasury securities, paying those who are giving the Fed cash 0.05% per year. So it's not a one-day payment per year, interest on that money to get that liquidity out of the financial system, because that is the big problem right now. There's too much cash in the system, and that's putting downward pressure on interest rates, forcing banks to do something different because they're afraid if driving money market rates below zero, which could happen due to too much cash, is a major threat to our financial system. It can't be done. So what does the Fed come in and do? It says, we'll take all the cash you've got, we'll pay you for it, and we're going to put a floor on short-term interest rates. But one banking expert thinks this is being done potentially to bail out the money markets. And let me show you that article. This was on Zero Hedge last week. And we're going to take a look at Zoltan Pozar. He is a Credit Suisse banking expert. And he says at 5 basis points, that's 0.05%, money funds, which is money markets, have incentive to trade out all of their Treasury bills. Boy, this thing is not holding still. There we go. Trade out all their Treasury bills and park the cash at the Fed repo facility. Now, why would that be? Well, imagine this. Imagine you have a bunch of Treasury bills yielding less than 0.05%. And yet someone else would be paying 0.05% on your cash. What are you going to want to do with those bills? You're going to sell them. So this is what he says. Let's take a look. He said, indeed, as shown below, bills have less than 5 basis points out to 6 months. So he's saying, look, if you've got a 6-month or shorter Treasury bill, you're probably getting less than 0.05% now. And money funds have over $2 trillion of these bills. They've got incentive to sell, while others have an incentive to buy. Institutions whose deposits have been tolerated by banks until now earning zero interest have an incentive to harvest the 0 to 5 basis point range the bill curve has to offer. Now, I will argue there is one part that doesn't make sense. Why did these institutional money managers just go to the Fed and get those 5 basis points themselves? And they may be doing it. That may be exactly what we're seeing in this reverse repo blowout. That's $765 billion. Let's continue on because there's a secondary issue here, and he doesn't get into that. So on net, the reverse repo facility turns from a largely passive tool that provided an interest rate floor to the deposits that large banks have been pushing away. And this is a key because we've seen negative deposit rates in Europe. And what does that tell big customers? Well, banks are saying, we don't want your money. And we've heard banks in the U.S. start to do that with some of their very large commercial bank customers saying, look, no more money. Well, now, no big deal. Give us all your money because all we're going to do is cycle it to the Fed and pay you a menial amount of interest, and we're going to make a tiny bit on the spread. So we'll take all of that cash. So let's go on into an active tool that sucks the deposits away from the banks that the banks decided to retain. And that's just exactly it. The banks aren't in a position to keep these deposits because the more of those deposits sitting there, the more downward pressure it puts on money market rates, potentially driving it below zero. And what this is doing now is putting a floor underneath that, keeping it up. But there's that other problem we talked about last week, and let's kind of revisit it. And that's a Treasury General account is still in wind down mode. And you can see here, they've got about another $300 billion that has to come off. So to get back to that nominal level where Janet Yellen said she's going to bring the balance back down to because she has to. So here we are at 650, 350 is down here in the middle range here. So it's $300 billion that needs to come off. So if you think about this from the perspective of a money market fund, you've got $2 trillion in T-bills. And $300 billion, I'm assuming you have all of those that are the 6 month or less, are probably going away. So now you've got cash. You've got to pay your customers some sort of interest, not much, a little bit. And you've got nothing to do. So you go to the Fed, and the Fed says, we'll take all of it. So what it looks like from Zoltan is perhaps this is a way to bail out the money markets, not just the banks, but eventually bailing out anybody that's got cash that can access this reverse repo facility. And as we talked about last week, what that means is more quantitative easing, more of this asset recycling system, because what did we see the Fed do? They raised the interest rate on that IOER, interest rates on excess reserves, to what? 0.15%. Remember that, 15 basis points. So incentivizing the commercial banks to buy more treasuries and cycle in the Fed. And wait till we get to the credit data. It was postponed Friday due to the holiday. It's back today. Wait till you see what the banks did there. Now let's talk about the unemployment cliff that's hitting. I've been wanting to talk about this, but now it's starting to become reality. Let me show you the story here. So millions of people and millions of Americans in 24 states are set to lose their unemployment benefits as early as July 12th. This article is June 12th. This article is a little old, but here you go. On June 12th, Alaska, Iowa, Mississippi, and Missouri, they lost their benefits. And then this weekend, Alabama, Idaho, Indiana, Nebraska, New Hampshire, North Dakota, West Virginia, and Wyoming joined them. And then later this week, Arkansas, Florida, Georgia, Ohio, South Carolina, South Dakota, Texas, and Utah are there, leaving then only 4 more states, Montana, Oklahoma, Tennessee, and Arizona, who will follow in the weeks to come to drop their benefits. Now, this is pretty serious because it doesn't mean they're just going to lose that extra $300 per week federal benefit. They're also going to lose programs for gig workers and others who don't qualify for aid, such as the pandemic unemployment assistance. And that's going to be a problem because for some people, as you see here, Oregon, Iowa, for example, would lose out on almost $4,000 in enhanced benefits and more if they're a gig worker. So some people aren't just going to lose part of their income. Some people are going to lose all of their income. And that's going to be a problem. So when we talk about all this inflation expectations that people have and that everyone's talking about, it's really hard to imagine how we're going to have more demand when a segment of the population's income is going down. And so you think about that. Where is the demand from those people going to come from? It's not. And that is one of the challenges when you have higher prices and a shortage of income to meet them. It eventually puts downward pressure on those prices and takes that inflation and turns it into deflation. It's kind of what happened back in the great financial crisis. Prices went up in the middle of the recession. As we've looked at it, the CPI, there wasn't enough money to afford it. It came crumbling right back down into negative territory. In fact, we'll take a look at the different states here. You can see on a map which states have benefits have now already expired and which ones are coming. Let's move on to some very interesting data from the Chicago Fed, because this, my friends, changed a lot of things. Because what the the Chicago Fed National Activity Index, CFNAI, tells you is the economy growing at trend? And so if you print a 0, it's growing at trend, which is great. I mean, that would be fine. If it's above trend, so it's above 0, you get above trend. If it's below 0, it means you're below trend. Let me show you what happened, because something very interesting has happened. And you could go back to let's go back to February. We see minus 1.09. So we saw what happened without stimulus checks. I mean, talking about a hard contraction in the national economy. I mean, that's a recession style print at minus 1.09. Remember, trend is 0. And then in March, the stimulus checks started coming out. Boom, we saw this huge jump to 1.71, big above trend growth. And that was phenomenal, even though they previously revised that minus 1.09 down to minus 1.2. Bad. And in April, we get a 0.24, which just, it just indicates that the stimulus money is slowing down. The growth from that is still above trend. I mean, 0.24 is a big number. I mean, remember, your benchmark is 0. So you're not supposed to see this thing go above or below 0 too much. So 0.24 says pretty good. It just says, hey, the growth rate is slowing down, which we would have assumed. That got revised down to minus 0.09, which effectively is saying is instead of above trend growth, we got slightly below trend growth. And then in May, which now makes me wonder, is this going to be revised lower too, comes in at 0.29, effectively saying, we don't know why that went down, but hey, everything's fine. But we know without those stimulus checks what's coming. So let's zoom into the CFNAI and we see what's going on here. And you can see sales, orders, and inventories factored 0.02 to the formula, which isn't much. Employment, unemployment, and hours, 0.16. And that unemployment we know is going to be changing in the future. And the unemployment number hasn't been driving as high as everyone's been hoping. Production and income, this is a staggering one, 0.29. So we know that's going down because we just talked about the unemployment benefits going away and lower, or either lower or away for some people. So we know that's going to drop. And personal consumption. So think about inflation, personal consumption and housing minus 0.18. So it's saying below trend growth. So if consumption is falling below trend, how is that inflationary? And it's not. It's not at all. And in fact, the prior month, personal consumption and housing was only minus 0.04. So you're seeing what happens as the stimulus checks go away, which suggests that perhaps there will be a revision for this next month. And as far as inflation expectations, well, that's easily dealt with because you only get inflation when the 3-month moving average, let's see, is, there it is down here, above 0.70, more than 2 years into an economic expansion. So the question is, are we above 0.70? And the answer is no, not even close. So the Chicago Fed National Activity Index telling us perhaps we're going to be back in recession territory, just like we saw here back in February, pretty sooner than anyone's really expecting. Take a look at the banking data. I'll have the charts for us on Wednesday, but let's take a look at this. So some good news, we see bank credit up 26 billion and securities in bank credit only up 9. So what's telling you is that there was obviously some lending growth. We'll find out where that is. Mortgage-backed securities, for a surprise, banks shut off 10 billion. But here, remember we talked about banks potentially buying treasuries? Well, there it is, up 17 billion. They haven't really been buying a whole lot, but now they're back buying. Isn't that interesting? How about loans and leases? And remember, no one thinks you should be, no one wants to buy treasuries. The treasuries are the worst thing you can buy, is what everybody's saying. And yet, banks are buying them. How about loans and leases? Up 17 billion. Commercial industrial down 8. Real estate up 8. So those two are a wash. But where is the growth coming from? Consumer loans up 6. And what are consumers doing? They're charging on their credit cards. Now, are they doing this because they have money and they're expecting to pay it off? Or are they doing this because there's a potential shortage of income? Don't know yet, but at least they're charging on credit cards. That's in the past been a good sign, but with money shortage may not be. Cash assets only up 2 billion. So all this tells us is what the Fed's plans for the money markets is going to be a lot longer with this reverse repo than I think anyone expects. They don't have an answer. The Treasury's obviously rolling off T-bills, and at some point, once they roll those off, they're going to build up their balance sheet a bit, but that isn't going to solve all the problems because the Treasury isn't going to exclusively issue the T-bills that banks need. So right now, the Fed, who normally acts as a lender of last resort, is acting as the cash sponge of last resort, saying we'll take all this cash without any clue what they're going to do with it, but making every effort to put a floor on money markets so they don't break the buck, because that would certainly be bad. But they'll remember, the longer they have to do QE, which at this point appears to be in perpetuity, the tighter financial conditions get, the more dollars get trapped in the financial system, the more downward pressure they put on long rates, and that tightens financial conditions, and that's what you see in the bond market. Anyways, thanks for watching. Appreciate you being fans. We'll be back on Wednesday, of course, for the macro show, when we got a whole lot more data coming to take a look at. I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video is provided as educational information only, is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by selling security, financial instrument, or to participate in a particular trading strategy. This video was prepared by Steven Van Metre, personal capacity. Opinions expressed in the video that do not reflect the Atlas Financial Advice Inc. or Steven Van Metre Financial.